Em mơ ưa thích em đang muốn gì, trong tôi đôi make up hôm nay em có gì. Em mơ ưa thích em đang muốn gì, trong tôi đôi make up hôm nay em có gì. Em mơ ưa thích em đang muốn gì, trong tôi đôi make up hôm nay em có gì. Em mơ ưa thích em đang muốn gì, trong tôi đôi make up hôm nay em có gì. Em mơ ưa thích em đang muốn gì, trong tôi đôi make up hôm nay em có gì. Em mơ ưa thích em đang muốn gì, trong tôi đôi make up hôm nay em có gì. Em mơ ưa thích em đang muốn gì, trong tôi đôi make up hôm nay em có gì. Em mơ ưa thích em đang muốn gì, trong tôi đôi make up hôm nay em có gì. Em mơ ưa thích em đang muốn gì, trong em mơ ưa thích em đang muốn gì, trong tôi đôi make up hôm nay em có gì. Baby lên fit me, đôi môi thông ra.
Everything changes.
broke down curtain. 4 years, no curves. Now I'm looking pretty in a hotel bar, and I can't stop. No, I can't stop.
Like a Hellcat. Like a Hellcat. Like a Hellcat. Like a Hellcat.
streets are empty. The only thing I can see is my own silhouette. I'm getting stronger, step by step. The clock is ticking, but there's no time for regrets. I've been flying from town to town, from London to Taiwan. I've been all around the globe, trying to protect your soul. We are heroes tonight. We will fly above the sky. We are heroes tonight.
Let's have a bit of fun till I downfall. downfall. My love, if you feel like I do right now, don't say you're on the run to the other side. My love, you say you wanna try, but you never do. Sugar, there's a reason why we lose.
changes.
ain't no stopping us.
Stock Market for Beginners 2018 edition. Well, welcome in. I am Jeremy. This is a financial education channel, and today I'm going to teach you, as a beginner in the stock market, as someone just kind of getting involved with the stock market, what are the steps you want to take, how do you want to approach this and whatnot. The hardest thing, as with all things in life, whether it's investing, starting a business, anything, the hardest thing is just getting started and knowing which route to go and all those type of things to do, guys. So as someone that's probably new to the stock market, if you're interested in this video, I'm going to help you out immensely today. The last time I did one of these videos, I think, was 2016. It's now 2018, so it's time for a little update, guys. I hope you really enjoy this today. Make sure you subscribe if you want to see a lot more stock market videos. I post a lot of stock market videos on this channel. So, stock market for beginners, where the heck do you start, okay? First off, like the attraction of stock market investing is that you can make your money into more money. So if you're getting involved with the markets, obviously that should be your goal, right? To make your money into more money. Obviously, if you're getting involved with the stock market, obviously with all investments, you can lose money as well. So you always got to think about that. But there's a lot of money to for sure be made out there in the stock market. That's up for you to do. So if you want to get started, what's the kind of like the first things you need to do? Well, the first thing, in my opinion, you got to figure out like what type of philosophy are you going to do in the stock market. Do you want to be a trader? Do you want to be an investor? Those kind of things. So you have a few different options. The first is you could be someone that's called a day trader, okay? You could be a day trader. This is not something I do. It's not something I recommend at all, but it is something you can do in the market. This type of activity, you have to do a lot of research as far as technical reports. You have to look at a lot of graphs and things like that. You're not really making investments in companies, and you don't really even care about a company, okay? You don't really care about a stock. You're just trying to make quick money and get out, get in and out of stocks, trade them several times per day, get in and out, those type of things, okay? It's not a philosophy I'm into at all. However, it's something you can do, and it is an option for you. You can be also what's called a short-term trader, okay? You can be a short-term trader. Another thing I wouldn't recommend at all, guys, this is not something, I'm into at all. I've tried this before, and I lost a lot of money doing this, okay, in 2015. This is where you go into stocks for maybe a week, maybe a month, maybe a couple months, and you're just trying to play events. Like companies announce earnings every 3 months, so 4 times a year they announce earnings, okay? Every 3 months. So a lot of people, what they do is maybe they expect the company to have good earnings, maybe they will buy into that stock, they'll go long that stock as it's called, or maybe they'll short shares, which is actually basically betting against those shares if they think that company is going to do bad and they're going to report negative numbers, okay? You as someone just getting in the market, you're probably 100% of the time going to be going long in stocks, meaning you're buying stocks figuring it's going to go up over time. So this is not something I would really recommend. This is a lot of speculation in there. This is, once again, not really investing, okay? The third route you can kind of go is options, okay? You can do options trading, which I actually have an options course. It's the second link down there in the description. I would not recommend that for any of you beginners out there. Options, in my opinion, it's fine to learn options if you want to learn about options, but as far as actually doing them as a beginner in the stock market, I do not recommend it at all. I would save options for when you've been in the markets a couple of years and you kind of got some experience behind you and you really know what you're doing, okay? It's options, you can save yourself a lot of money. You can also potentially make yourself a lot of money, much more money with much smaller amounts of money. But for a beginner in the stock market, I just don't recommend it. I don't think it's the right way if you're a beginner in the stock market. I think once you're an advanced investor and you've been in the markets for a while, you can start doing a lot of different option things and understanding the power of options. But for a lot of you that are going to be beginners in the stock market, I don't really recommend it, okay? The fourth option is kind of, which is really my philosophy, which is
dường như một phụ nữ được rất bận với mọi việc. Vậy đánh đàn ông thì làm gì? Có vẻ như họ chẳng làm gì cả. Mà có thật như vậy không?
Ủa gì vậy anh? Con Tâm muốn cảm ơn anh vì đã góp phần tạo nên một cái Tết trọn vẹn. Em chỉ chở mẹ đi chợ thôi.
Tết đến, Bên cạnh sự vun vén của người phụ nữ, còn có sự đóng góp thầm lặng của những người đàn ông. Những người luôn sẵn sàng chở người phụ nữ trên chiếc xe của mình, cùng mang Tết về nhà một cách an toàn, bền bỉ. Đàn ông thực sự góp phần làm nên Tết.
Phải à, vậy em được gì anh?
Cùng Total chở Tết về nhà, mượt mà, bền vững.
Which is what I call a 1 to 5 year buy and hold type strategy. Okay, so there's a lot that goes into this as far as what I look for in a company. By the way, I have a full course on that. First link in the description if you want to check out that. That's my entire strategy behind like how I pick stocks and whatnot. But basically, in the simplest terms, I'm trying to look for companies that, in my opinion, over at least a year out, but over the next like 2, 3, 4, 5 years, I can see the vision for the company. I can see where the company's going, and I'm judging it off of all these things I'm looking into, right? And I'm holding it for that amount of time. When shares dip, I buy more, and I always go somewhat small when I first initially make a position in case the shares go down. I can buy more. If they go down even more, I can buy more shares. As those shares appreciate, as long as I made a good decision in that company, a good investment in that company, I can sell my shares for a bigger and bigger and bigger profit at the end of the day. So that is more of my type of strategy. And then the last kind of strategy you can do if you're in the markets is what I call buy and hold forever, okay? So this is a type of strategy where you buy a stock and you're planning on holding it for, I don't know, the next 20 years or until you're 50 years old, until you're 80 years old. This is almost like a kind of like a Warren Buffett philosophy, even though Warren Buffett even gets in and out of companies more often than he used to, okay? Warren Buffett kind of used to buy stocks where he might hold it for his entire life, but nowadays he really gets in and out of stocks. Why do people kind of get more in and out of stocks now, over a few year basis? Well, I think a lot of people have kind of moved more to my strategy because my strategy makes more sense in today's climate because things can change so fast. Companies can get knocked off so fast, guys. I mean, a company can be on top of the world. 5 years later, they're like non-existent. Think about BlackBerry. BlackBerry in 2013 had 85 million subscribers, okay, on their phone plans they had and whatnot. They were like the premier smartphone maker, and that's when they peaked. And nowadays, we look at BlackBerry, in 2016, 2017, and 2018, as their phone business is pretty much non-existent. They're in a complete turnaround mode. BlackBerry's in a complete turnaround mode, trying to turn that company around now. If they didn't have so much money on the balance sheet, they could have potentially went bankrupt, guys. And that was a company that, 4, 5, 6 years ago was on top of the world. That's how fast it can happen now. You can get knocked off so quick. So the whole, let's buy into a stock, hold it for the rest of my life, I just don't think it applies anymore because of the technology game and how fast things can change, how competitive the world is on a global scale. You have so many competitors coming in from so many places, coming in to try to knock you off. I don't think that whole buy and hold forever philosophy is really realistic anymore, which is why I think my 1 to 5 years is the best plan. So that's the first thing you got to understand. Like, what is your thing? What type of investment philosophy or trading philosophy do you want to do? Which one of those 5? And those are really your main 5 options out there, okay? So now that you've figured out, hopefully, and it might take you time, you have to read some books and whatnot, which way's right for you, and go to the library. There's a ton of different books if you want to read about some of those different ones, day trading and whatnot. You can also watch videos here on YouTube, figure out which one's best for you, okay? So now you figured that out. Now what you need to do, step number...
In case you were wondering what separates this channel from Casey Neistat or Cody Lehner, it's that I am not a morning person. I'm not a morning person, I'm not a breakfast person, but this morning we're having breakfast with a couple of founders of a company called The Citizenry. They travel the world and find local artisans, buying those products, help those communities, and then selling those artisans' products directly online. Chris is picking me up now. It's barely light out. Time for breakfast. So early, it's starting to feel like a real job. When did you get involved with this company? I think it was 2 years ago. I was the
I might have been the first seed investor, and I invested after just a 15-minute meeting purely based on my impression of the two founders, Carly and Rachel. They've been killing it for 2 years now, and this is the company that should have never worked.
And 2 years ago, they were just completely brand new startup, barely had a website.
They had nothing.
We sold it from 160 to 200 or something like that.
A nice tidy profit.
Yeah, we made about $3.5 billion on a $500 million investment. As it turned out, I still sold it way too soon. Since I sold it, they must have shot a gun off and said my board and sold the dollar sign to let it go up.
Yeah, you left money on the table.
A lot of money.
Dummy.
That's exactly right.
Munger would say.
Charlie would say you've done it again.
But you can't keep always trying for the average person who's maybe never bought a stock before. What's your advice about that? You can't constantly sit there and wait and say, oh, it's going to go higher, it's going to go higher.
We don't even think about that. What we think about is how much is it selling for? How much do we think it's worth? When we bought it at $35 billion effectively, I felt the company was probably worth at least $100 billion.
How did it come to your attention? How do you find a stock like PetroChina?
I sit there in my office and I read an annual report, which fortunately was in English, and it described a very good company. And told about the oil reserve, told about the refining, told about the chemicals, everything else. And I sat there and read it, and I thought to myself, this company is worth about $100 billion. Now, I didn't look at the price first. I look at the business first and try and figure out what it's worth, because if I look at the price first, I'll get influenced by that. So I look at the company first. I try to value it, and then I look at the price, and if the price is way less than what I just valued it at, I'm going to buy it.
And how do you value it?
Well, that's the trick. But it's essentially what I would pay for the whole business if I could buy it. And when we sold the company stock, it was valued, we'll say, at probably 250 to 275 billion. And we thought that was a fair price. Now, oil had gone up from $30 a barrel to $75 a barrel. Now it's up even further. But today, yesterday anyway, I believe PetroChina is the second most highly valued company in the world. Higher than GE, next to Exxon.
ExxonMobil.
Next to Exxon.
Have you sold the entire stake?
Yeah, I have. Mm-hmm. I wish I hadn't, but I have.
As of when?
Well, we sold it over a period of time.
Sold it over a period of time.
If it went down a lot, we'd buy it back.
Would you ever buy or sell a stock based on political pressure or
no.
sort of...
So no, the answer is no.
People being upset about Darfur had nothing to do with why you sold this stock.
The Chinese government owns 88% of PetroChina. They also own control of 29 out of the 30 largest companies in China. The Chinese government is the one that has a position in relation to the Sudan. And they have it, if you own any one of the 30 largest companies in publicly traded companies in China, you will have the Chinese government as your majority partner. And the question is, are you responsible for their actions?
You're going to China next week for a ribbon-cutting ceremony for ISCAR. One of
sort of the limit of my abilities, Liz. I mean, that's what they use this.
You're pretty good at cutting a ribbon.
I've gotten used to it, yeah.
Are you looking at other companies in China?
I don't look based... No, the answer is pretty much no. But I don't look based on countries or that sort of thing. I just read every report I can, and I try and figure out whether something is cheap.
But how would you find a report like PetroChina 4 years ago? This was not a name that maybe that a lot of people would...
Other guys read Playboy. Yeah. I read annual reports.
ਆਥਣ ਦੇ 8 ਵੱਜ ਗਏ 6:30 ਦੀ ਮੈਂ ਬੈਠੀ ਸੱਜ ਕੇ ਪਹਿਲਾਂ ਆਉਂਦਾ ਸੀ ਤੂੰ ਬੜਾ ਭੱਜ ਕੇ ਕਿਉਂ ਹੁਣ ਮੇਰੇ ਕੋਲੋਂ ਤੁਸੀਂ ਰੱਜ ਗਏ ਮੈਂ ਵੀ ਸਾਇਲੈਂਟ ਫੋਨ
How's it going today, guys? Welcome back to the channel. So in this video today, we're going to be talking about investing in the stock market as a complete beginner. Now, this is actually a video I covered just about 2 years ago to the day. Back in October of 2016, I believe it's my first ever, or one of my first YouTube videos I made, was called Stock Market for Beginners. And that video is still good. It has some decent information, but a lot of the stuff that I talk about in that video, I have a slightly different opinion about it now. And largely that is due to the fact that back when I made that video, what I was doing was swing trading. I was trying my hands as a swing trader. And so oftentimes in that video, I'm referring to trading as opposed to investing. And so I kind of want to share with you guys what I've learned over the last 2 years of making videos relatively frequently about investing, being invested in the stock market, reading dozens of different books. I have a lot of good information to share with you guys here. So I'm going to cover with you my top 10 stock market lessons that I've learned over the last 2 years and prior to that as well. So it's an update video from that video 2 years ago, and it's also, you know, a lot of information that I've developed and learned over the last couple of years as an investor. So if you guys are not familiar with who I am, my name is Ryan Scribner. I've been investing in the stock market for about 5 years now. Like I said, I started off as kind of a swing trader. I've done many different things. I've never been a day trader, but I've tried swing trading. I've tried, you know, betting on earnings reports and things like that. And what I found over time is that the only time I was able to be predictably profitable with my investing was by being a long-term investor. Now, my background is actually in electrical construction, so I don't have any kind of finance background. I'm not a financial advisor, so I am a self-taught stock market investor. And so basically that is my background, and that pretty much gets us up to this point here. Okay, so now that we have that introduction there out of the way, now I want to get into the basics and give you guys some realistic expectations when it comes to investing in the stock market or trading stocks or whatever it might be that you're looking to do. Because anybody who's watching this video, you could be in completely different areas in terms of what you're looking to learn. Some people might be interested in day trading, some people might be interested in Forex, some people might be looking to get into cryptocurrencies, some people might be looking to be a long-term investor. And so what I want to do at this point is kind of give you guys realistic expectations as far as what you should be looking for out of these different investing mechanisms or methods of investing. So first of all, I want to share with you guys a statistic as far as active traders go. Now, active traders are people who are buying and selling stocks on a regular basis. This could be day traders. This could also be swing traders. It's basically people who are making short-term moves in the stock market. Well, they were able to look at data from different exchanges out there and determine how many of these short-term trades were actually profitable. And what they found was that 90 out of 100 active traders were losing money. So 90% of active traders end up losing money. Now, of those 10 who actually make money, 1 out of 10 of those people are what you call predictably profitable. So essentially, your odds of being a predictably profitable short-term trader or active trader sits at around 1%. So for every 1 successful trader, there's 99 who are unsuccessful. Now, am I discouraging you from being an active trader? Absolutely not. I think you guys should do whatever really interests you, but I just want you to have realistic expectations getting into this and not thinking that, you know, most traders are successful. That is not true. Most traders are unsuccessful. About 1% are predictably profitable. Now let's talk about investing in the stock market and being a long-term investor. What are your odds of really being successful? Well, what we can do is look at data from mutual funds to determine what is the average rate of people who are actually beating the market. Now, when I'm referring to the market, what I'm talking about is the S&P 500. It is the culmination of the 500 largest publicly traded U.S. companies. A lot of people will use this as a benchmark to determine how the overall stock market is doing, and when people refer to themselves as beating the market, it means they beat the S&P 500 return. So over the last 15 years, there was 15 years of data that this was used to calculate these numbers. 7.8% of large cap mutual funds were able to beat the S&P 500, and 92.2% of these large cap mutual funds fell under the S&P 500. Now, these are professional stock pickers. These mutual funds are managed by professional investors. They're managed by teams of people with billions of dollars of assets, and they have so much money to devote towards research. They have so many different members of their staff that are researching investments every single day. And even with all of these different resources available to them, just under 8% of them were able to actually beat the market. So if you want to take a step back and think about, well, what are my odds of beating the market if only 8% of the professionals, or less than 8% of the professionals, are able to do it, your odds of beating the market are not good. Now again, is it possible to beat the market? It absolutely is, but I just want you to understand that the odds are not in your favor when it comes to being an active trader or when it comes to, actively picking stocks and looking to beat the market. Am I trying to discourage you from doing this? Absolutely not. My personal investing strategy is 50% individual stocks and 50% into index funds. And so I do put half of my money, my portfolio, into individual stocks just because I really enjoy the process of picking stocks, researching investments. And so personally, that is why I choose to do it. And in the long run, I do hope to beat the market, but I know that really it's never guaranteed. And just in case I don't, that's why I have half of my money in index funds where I'm actually owning the market. Now, I forgot to mention this as well, but if you guys are looking to learn more about investing in the stock market, of course, I have my YouTube channel here with over 100 different, or probably 200 plus different investing videos. I also have a blog I've been working on for the last couple of months. It's called investingsimple.blog, and I actually put together an article over there that's more like an ebook. It's about a 10,000 word article called A Beginner's Guide to Investing in the Stock Market, and it's going to go through everything we talk about in this video, but into a little bit more detail. So if you guys are looking to learn more about investing, that is a really good resource I've put together. I'm very proud of it. Dozens of hours have gone into creating that, so I'm going to link it up down in the description below, but I would appreciate it if you guys would bookmark my site, investingsimple.blog, because there's going to be a lot of really good information over there for you guys who are looking to learn more about investing. So the main takeaways I want you guys to get from this introduction here with your realistic expectations is that, first of all, active trading is not as lucrative as it seems. A lot of people are running ads saying, oh, they're making millions of dollars trading. Maybe they are, maybe they aren't. But the data speaks for itself, and it shows us that most active traders are unsuccessful and 90% of them are losing money. The second thing we have to understand here is that it's pretty difficult to actually beat the market, and under 8% of the professional stock pickers are able to do this. But there are some factors involved here, and there are some limitations that these fund managers have. They're managing billions of dollars, and they can't nimbly move in and out of stocks, and they're limited to just investing in very large companies because they have to invest so much money to have a meaningful position. And if they were buying small companies, they would have to own half the company or more just to have enough skin in the game. You, as the retail investor, have a couple of advantages. One of the big ones being that you are not limited to just the largest 50 or the largest 100 publicly traded companies. You could possibly unearth, small cap value and find hidden gems that these large fund managers are overlooking. So that is one of the clear advantages you have as the small retail investor. And then finally, like I said, if you guys are really just looking to own the market, you can be an ETF investor. You can go that self-managed approach, which is what I do. I buy ETFs, I buy index funds. You could talk to a financial advisor, but if you don't have a lot of money to be investing, they may not take you on as a client. But another option that has come up in the recent years is these robo-advisors, and this is basically an algorithm-based financial advisor. And the key benefit to this is a very low fee structure, and the fact that with Betterment, one of the most popular ones out there, there is no minimum account balance. So if you were to go to your financial advisor and say, hey, I want you to diversify and invest $100 for me, they may not be able to do that for you because it's not worth it for them. But because Betterment is a robo-advisor and they're algorithm-based, it doesn't matter. They'll take on very small accounts. And if you guys are interested in signing up for Betterment, I have a link down in the description below. It is an affiliate link. You do not have to use it, but understand if you do, it helps to support my channel and allows me to make more videos like this. Okay, so now we're going to go ahead and get into the first lesson here for the stock market beginners that you have to understand. I'm sure you've heard it before, and that is to buy low and sell high. Now, I know a lot of people are thinking that this is just common sense. Everybody should know that the way you make money in the stock market is buying low and selling high, but it's not common sense because most people I hear from in the comments of my videos, most people I talk to are doing the exact opposite of that. They're buying stocks high. They're buying at all-time highs, hoping it's possibly going to go higher. And the thing is, there's no guarantee at that point that that stock is going to go any higher. They're buying high, hoping for it to go higher, but in most cases, they're going to buy high and then they're going to sell low. So understand that, especially as a beginner, you are very prone to making this mistake of buying high and selling low, which is the exact opposite of what you're looking to do. Now, the main place that this is actually happening is in something called a speculative bubble. Maybe you've heard of these before, if you've heard of the dot-com bubble, if you've heard of the 2008 housing market bubble, if you've heard of cryptocurrencies, possibly even marijuana stocks. These are speculative bubbles that form in the market, and a lot of brand new or novice investors get caught up in these, and they can be a very painful learning experience. Now, this chart over here is exactly what a speculative bubble looks like, and I want to walk you guys through this process. Now, while this might look like a fun ride if it's a roller coaster, it's not going to be a fun ride if you're an investor, because most people, the general public, the average retail investor, well, they're getting involved right about here, somewhere in this upward movement of this trend when the general public is learning about a particular investment. And at that point, it's pretty much a slippery slope downhill. I never invest in anything that's having any bubble-like appreciation, but unfortunately that's where a lot of the excitement is. A lot of people hear about, crazy returns that were being made with cryptocurrency or marijuana stocks or even, technology companies and internet companies in the 2000s, and they want to be investing in the exciting new thing. Well, here's what you have to understand about these speculative bubbles. Number one here, all the way at the very bottom left here, we have the early innovators. These are the people who really understand the technology or the innovation. If we're talking about Bitcoin, these were the people who bought it in 2011, 2012, very early on, before it was mainstream. They really believed in the technology, and they were the ones who were the cutting edge innovators of this trend. Now, number two here, that's where we have the institutional investors, the large investors. They catch wind of these new investments long before the general public does, and if they see this as a good investment, they're going to say, okay, we want to put some money towards this. Remember, as we said earlier, these professional fund managers have millions, if not billions of dollars that they're investing, and they have teams of people doing research every single day. They're going to hear about stuff before you do. It's just inevitable. There's no way that you're going to hear about a particular stock or a particular cryptocurrency or anything like that before these large fund managers. So they're going to take a look at it and they're going to say, okay, yes, I want to invest this fund's money into it, or maybe when we want to stay away. But right here at that number two, that is when these large institutional investors are getting involved. Now, where we see this line really start to take off and go up like a rocket, that is when it hits the general public. That is when the general public catches wind of a particular investment and the average retail investor is beginning to buy this particular asset. And that is when we see it start to shoot up like a rocket and then come crashing down. It's happened so many different times, guys. Try to avoid getting caught up in these speculative bubbles. It's not going to be a fun ride for yourself, but it will be a very valuable learning experience. Now, the other lesson I want to give you guys here, one of my favorite analogies to share about buying low and selling high with the stock market.
Căng thẳng có thể dẫn đến triệu chứng khó tiêu, ở nóng. Dùng Gavisco Duo Action tạo thành một lớp gel axit anhydric ngăn chặn ngược dạ dày thực quản đến 4 giờ và trung hòa axit dạ dày, làm dịu nhanh chóng triệu chứng khó tiêu và ở nóng. Gavisco Duo Action chứa natri alginat, natri bicarbonate và canxi carbonate. Không dùng Gavisco Duo Action cho người quá mẫn cảm với bất kỳ thành phần nào của thuốc, bao gồm các parabens. Đọc kỹ hướng dẫn sử dụng trước khi dùng.
Is by using an example of looking at a grocery store. So we all go grocery shopping, or we at least have a general idea of what we're going to be paying for certain products, possibly soda or cold cuts or chicken. We have a general idea of what these things are worth, or laundry detergent. So let's say, for example, you regularly buy Coca-Cola. Yeah, it's probably bad for your health, but whatever. You're buying 2 liters of Coke and you buy 1 or 2 every single week. And you know that you usually go to the store and you expect to pay $2 for that 2 liter of Coca-Cola. Well, all of a sudden, you go to the grocery store and you find out that 2 liters are on sale for $1, meaning that you can buy this 2 liter for half of what you normally pay. What are most people going to do? Are they going to buy just one? Probably not. They're going to stock up and they're going to buy multiple items. They're going to buy many different items here, and they're going to buy a bunch of different 2 liters because of this massive sale going on. So when you see prices of goods on sale, people will stock up and buy more. Now, on the other hand, we have Coca-Cola stock. Coca-Cola stock, obviously this company makes Coca-Cola, and this stock usually trades somewhere around $50 per share. But let's say, for example, this stock has a pullback and it goes on sale by 20% down to $40 per share. People don't buy it. They're afraid to buy stocks on sale. You'll go to the grocery store, you'll buy Coca-Cola soda on sale, you'll buy laundry detergent on sale, but you're not going to buy Coca-Cola stock or Procter & Gamble stock on sale because as soon as people see stocks going down, they become fearful and they don't want to invest. So understand this again is another one of the cardinal reasons here why people are afraid to invest in stocks. It's because when they see them going down, they say, you know what, I don't want to be a part of that. But that is the exact time when you should be buying is when these stocks are on sale. It's just like loading up on, Coca-Cola when it's on sale at the grocery store. Okay, now the second lesson that you have to understand or learn as a beginner in the stock market is to ignore the noise. Now, there's a blessing and a curse at this point in time or in this day and age, and that is that we are surrounded by information streams and information outlets. Now, this can be good and it can be bad, but what this means is that you always have people sharing with you their opinion about your investments or pretty much anything in general. And so you really have to start to ignore the noise when you become an investor. When you invest in a stock or a particular company, you're doing so because you believe in this company, and later on we're going to go over some of the factors I look into or my investing plan. So you have outlaid or laid out, a plan for your investment. You know why you invest in this company. And so your opinion shouldn't be swayed by just anybody. But today we have so many different things or outlets out there that could sway your opinion. It could be people at work. It could be the news stations. It could be your television. Heck, it could be YouTube. There are a lot of people on YouTube now, sharing their opinions on stocks, myself included. It could be Wall Street analysts. It could be friends. It could be bars. The thing is, when you become an investor and you're investing in stocks, it's almost kind of like sports. People talk about the stocks they invest in because it's kind of a fun social talk, but you have to make sure you have a difference there between, the social side of being an investor and talking about stocks with your friends versus having anybody be able to sway your opinion and make you decide, okay, you know what, my friend Joe says I shouldn't buy this stock or maybe I should sell it because, Sarah's selling hers. You don't want to be following other people blindly or letting anybody sway your opinion. And what you have to understand is that at the end of the day, activity is what makes money for Wall Street. They're going to make money when you're active. They want you to buy a stock on a Monday, sell it on a Thursday, next week buy a different stock, sell a stock that week. They want you to be buying and selling stocks all the time because they make money from commissions, they make money from trades, and the more frequently you are trading your stocks and changing your mind, the more they are making money. So they're going to do as much as they can to share, news stories. They know that when they, exemplify details and blow things out of proportion, more eyeballs are going to be on that news article. So they're going to do everything they can to make things sound more dramatic than they are. And this is why, typically speaking, you get more drastic reactions to events in the stock market than you should. Now, as a smart investor or an informed investor, you understand that's where opportunities might lie, is when there's a drastic overreaction to some kind of news report. But understand that most people are going to make that mistake of listening to too many sources, getting too much information, and maybe even possibly making bad decisions because of what their friends say or what they're hearing on YouTube or what they're seeing on TV. Now, what about stock tips on the other hand? What if you're at the bar or you're at work and one of your friends comes up to you and says, hey, I got this great stock tip for you. My friend works at this company. He says the stock is going to go up or this stock is going to get, acquired by another company. You should buy in right now. Should you listen to stock tips? Well, this is what I have to say about that. Your investing strategy at the end of the day needs to be two things. Number one, it has to be scalable. That way it works with $10, it also works with $100, it also works with $1,000, $10,000, and so on. So it works the same amount of money you put in, regardless of if you have a little bit of money or a large amount of money. And second of all, it has to be repeatable. At the end of the day, your investing strategy has to be something where you can consistently put money into it, and it can pretty much reliably put money out for you and spit money out based on your strategy. Is the strategy of getting random stock tips at the bar or at work a good investing strategy? It's certainly not repeatable because you don't know when you're going to get your next tip. Even if you're right, even if that person is right and you buy that stock and it goes up like a rocket and you sell it and you make a bunch of money, what is your next move? Is your next move just to wait until somebody else randomly comes up to you with a stock tip or you overhear a conversation at work? That is not an investing strategy, and I would discourage you from following it and falling into this mistake of listening to stock tips. You need to learn to make your own investing decisions, and if you don't want to do that, then you should just be a passive investor. You should, you could be self-managed, like I said, like I am myself, by buying ETFs. You could look into a robo-advisor, a financial advisor, but you should let somebody else, make these decisions on your behalf, or just be somebody who owns the broad market rather than picking stocks. And as far as keeping track of your investments and reading news articles and being informed as an investor, you need to understand there's a very fine line between being informed and being obsessed. It's very easy to become obsessed with investing or obsessed with your stocks, and you're just taking in too much information at once. And the issue with that is it's going to cause you to make jump decisions. Personally, I don't read every news article about the companies I invest in. I do read earnings reports, and I do keep track of major interviews with management. But as far as the short-term noise goes, I pretty much just ignore it because I make sound investments based on my strategy and based on my own research. And I don't let the thoughts and feelings and what others have to say about my investment sway my decision.
In case you were wondering what separates this channel from Casey Neistat or Cody Wayner, it's that I am not a morning person. I'm not a morning person, I'm not a breakfast person, but this morning we're having breakfast with a couple of founders of a company called The Citizenry. They travel the world and find local artisans, buying those products, help the communities, and then selling those artisans' products directly online. Chris is picking me up now. It's barely light out. Time for breakfast.
So early, it's starting to feel like a real job.
When did you get involved with this company?
I think it was 2 years ago. I was I might have been their first seed investor, and I invested after just a 15-minute meeting purely based on my impression of the two founders, Carly and Rachel. They've been killing it for 2 years now, and this is the company that should have never worked.
And 2 years ago, they were just completely brand new startup, barely had a website?
They had nothing but an idea.
We are in the process of closing out our Series A. So we launched 3 years ago, 2015. Chris came in as a part of that seed round. We've raised about $3 million since then. We're raising $5 million, focusing on building out brick and mortar in New York, San Fran, and LA.
So excited about that.
I know. I think it's going to be
so excited.
Just
like
fantastic
single point Soho location.
Exactly. So Soho, Nolita. We're probably going to be in Hayes Valley in San Francisco.
So, what we are going to be talking about is how to invest in the stock market for beginners. I've invested a lot of my money. In fact, I've invested most of my money in the stock market over the past 4 years because I am 22 and I am a pretty good investor. I've only lost on one deal, and I'll explain what that deal was and why I had to lose money on it. So yeah, we're going to talk about some basic principles that I wish I knew when I started out. And, well, I kind of did know, but like when I was starting to gather my research, I was researching from what's called spec, tech, and we'll just say commodities, I guess. Com. Okay, that stands for commodities, the com. Okay, so stay away from those when you're starting out. Unless you're on Wall Street, just don't buy these for the most part. So a lot of people lose a lot of money betting on the tech industry, on a tech company. Speculation. So what speculation is you're essentially, it's a stock without a dividend in the first place. And I guess I'll explain what a dividend is. But you're essentially putting all your eggs in one basket that the value of the stock will go up within a day or a week. And if you don't make money on that, you could lose a lot of money. A lot of people do. So don't do speculation. Always invest in the long term, or at least middle, like 2 to 5 years or 5+ years, or maybe even 6 months. Depends. But don't do speculation. So don't invest for the short term. Don't invest into a lot of tech companies unless they're Apple that pay a dividend. And don't go for too many commodities. Don't go for like gold all the time. Don't go for silver. Those are cyclical. Okay, those are pretty much speculation. Stay away from those unless you know what you're doing. But you're a beginner if you're watching this. Okay, so again, this is a dividend. So get dividends. And I'll add a second part here. And reinvest the dividends. Okay, so a dividend, what it is so a lot of companies, they will, if you invest in a stock, let's just say $100 in your stock, a lot of companies will pay you a certain percentage for investing in the company. So it's a way of driving the value of the stock up. It's very smart. So what, let's just say, $100 stock, let's just say it's a bank, they pay back 4%, okay? So every year, for every stock of the $100 stock you own, you're going to be getting back $4, no matter what. So those stocks are usually very, very safe. Well, actually, high dividend stocks are actually not safe. Usually the middle range, like banks, that are pretty safe for the most part, in Canada at least. And so now the greatest power in finance is compound interest. And what do I mean by that? So all the dividends you get, if you were to reinvest them into other dividend-paying stocks, it'll increase the overall value of your portfolio, and you'll be getting back more dividends every single time you reinvest. Meaning that, so I read a study actually, and people who invest in the stock market and reinvest their dividends, they can earn over $1 million more in their lifetime than the people who get their dividends and spend it on jewelry or something, on random stuff. So reinvest your dividends. In the long run, that's going to be the best thing you can do probably. And reinvest your capital gains as well. So if you sell a stock for more than you bought it for, reinvest that into another stock. That's how it should work. Don't take out all your money and buy a car, all right? It's dumb. That's what a lot of people do. Okay, so what's next on my list? I think that, so I said reinvest. So this is kind of a basic principle that people do not stick to. And for whatever reason, oh my God, this bothers me. So buy when everyone else is selling. So why? What do I mean by that? Buy when everyone else is selling. So usually when people are selling, the market is bad, or it's predicted to be bad very soon. And so usually when people are selling, that's when the stock will be at its lowest, okay? During a recession, when everyone's selling to get out, to make sure that they don't lose more money, what happens is you get people that become very rich during recessions because the stock can only go up from there. So here's another thing that I want to talk about. So also sell when everyone else is buying too. It's vice versa. But here's the thing. If the value of your stock goes down, within a week of buying it, or a month of buying it, or 6 months, don't sell it. Under 99.99% of circumstances, don't sell when the value of your stock goes down just because you get scared. That is the worst thing you can do. You're automatically losing money. Now, there are certain cases where you should do that, okay? There are very, very, and I'll explain one example that I went through where I had to do that and I had to lose money, which ended up working out very well for me. So I'm going to give you an example here. And it goes along with this next tip here. Pay attention to the news. Big one. It can save you a lot of money if you do this, okay? So I'll tell you my example first. Let's just see, this was 2013, 2014. My friend, I remember this, my friend in university came up to me and we were talking about some global crisis. It was, at the time, what was it? Something going on, I think it was Egypt actually. It was Egypt's revolution. It was around that time. And then for whatever reason, we got off topic and he brought up the word fracking. And I never heard this word before, fracking. So I kept asking him about it and he said pretty much the US, what they want to do is they want to get more oil by using all this complex system, and it's going to damage all the lands and stuff. But I thought of it too. That's going to be horrible. But I thought of it as, dear God, the U.S. is going to increase the supply of oil by a lot in a very short period of time. And so the value of oil is going to go down. The oil stocks are going to go down. I was invested in an oil company. At the time, it was Canadian. It was stationed out of Alberta. What was its name? Sorry, this was a couple years ago. Was it Kayara? No, it might have not been. It might have been Kayara Oil. I don't know. You can check that. It was one of those Alberta oil companies in Canada. And I remember, within 24 hours of my friend telling me about this oil fracking and me looking it up, I sold all of my Kayara, I think it was Kayara oil stocks. And all of my Canadian oil stocks were gone within 24 hours. And, I ended up losing, it was essentially zero. It was like $20 I was invested over $1,000 in that. Which again, for most people, for a lot of you, 30-year-olds watching this, that's not a lot of money. For a student, that's a decent amount. For $1,000, it wasn't my largest holding at all, but it was $1,000 in Kayara, and I sold all of it. I lost $20 or $50 or whatever the hell it was. And I remember checking that stock price 6 months later, and I saw this recession coming. Actually, I took a lot of my money out of my Canadian investments because I saw this kind of come in this Canadian recession. Because a lot of our economy is based off of oil, right? Especially in Alberta. And so I sold a lot of my Canadian stocks, and yeah, they ended up going. We got hit pretty hard by this. We're going through a recession right now, America, because of your fracking. So thanks. So I sold all of those, and it ended up plummeting. All those prices ended up plummeting just because my friend told me about this word fracking, which I'd never heard before. Amazing, right? So just stay out for random stuff like that. Pay attention to. The other thing too is it's vice versa. I remember one day it was the new iPhone came out. This was last year? It was 2 years ago now. Wow, it was 2 years ago. And everyone was buying all my friends pretty much converted from Android or whatever the freaking phone they had, Samsung, to iPhones. Literally within a month, 4 of my friends bought the new iPhone. And this was in September. So I bought this stock because I was like, oh God, there's just from what I can see around me, their earnings are probably very, very high right now. And I remember 2 weeks after I bought that, they released their earnings report and the stock increased by $20 within weeks span. And I ended up buying it for $85-ish. And I think it was 85. It might have been 80. Something around there. And sold it for $131 American. It was great. Each stock. I don't know. I probably bought $1,000 worth of them. No, it was about $1,000. So I ended up making almost 40 or 50% on that investment. It was good. So pay attention to the news, everyone. Very, very important. Another thing, if you're just starting out, just keep in mind, don't invest less than for your bank, right? They have fees every time you buy a stock because it'll limit the amount of, I'm trying to think of a better word, the amount of increase that the stock has to have to make it pay off for you. So if you invest $500 in a $50 stock and the fee is $10, if the stock goes up $1, then you've already made your money back. If it goes from $50 to $51, you've already paid the fee off that you had to pay the bank. So just something to keep in mind. And so, yeah, this is kind of all the basics that I wanted to go through. I guess a few more things I should say. Don't invest all of your money in one stock. Just something to keep in mind. So I just said $500 at a time. Don't invest everything in one stock. Try to do $500 here, $500 there, $500 there, $500 there. Don't put all of your eggs in one basket. That's again, dumb thing. Try and invest in as many dividend stocks, but yeah. And I think that these are just kind of the core things that I go through investing. Do your research too, but keep in mind a lot of research on the internet is BS. The only research I use Like, literally, the only research I use is literally graphs and earnings reports and, you know, pretty much the statistics you can get from the stock itself. Not from the company, not from speculators, not from news agencies, but from the physical, mathematical numbers that they have on the stock over time. So I look at all of the charts, and that's all you really need. I'm one of those rare investors. I've only had one loss, and I've had 3 big gains, one of which was in tech systems, one of which was in Apple, one of which was in Nike. And Nike had a lot of my holdings too. I'm glad I sold that because I made a lot of money on that one. So just keep in mind, and sell when everyone else is buying. Just do all of this, guys. Do all of this, and you're going to be fine. Live by all of those. Live by all of these tips here. So, do you guys have any tips? Leave your tips in the comments. I kind of want to know what your tips are. These are just the ones that I've been able to build since I was 16, and they've really helped out a lot. So, just leave a comment and let me know what you think. Subscribe. Heart me on Periscope, please. I'd like that. And I just want to thank you very much for watching. These are just my beginner tips. And you are all very beautiful people. And I will see you guys next time. See you guys tomorrow, YouTube. And I'll see you in about a week on Periscope. Thanks for watching, everyone.
He's the world's most successful moneymaker. Warren Buffett has more money than the gross domestic products of more than half the world's countries. On the latest count, he has $40 billion.
I think you guys are earning your money.
And he made it all by simply investing in the right companies.
Some people are better at certain things than others. You know, there's a lot of people who sing a lot better than I can. I'm better at making money than most people.
If you'd trusted him to look after $10,000 for you when he started out, you'd have a cool $50 million now.
This was one hell of a wallop of money.
Everyone who's anyone wants to be seen with him. But Buffett himself remains charmingly down to earth. The world's super rich have often found themselves reviled of late. And Mr. Buffett has his doubts about them too.
The idea that the people that move money around are some favored class strikes me as getting pretty far away from where we should be.
Buffett is different. He's built a huge business empire and has developed his own special way of running it.
He's a unique leader. I can't think of anyone close.
What you see is what you get. Absolutely 100%.
Warren Buffett has given me a rare chance to explore his world. I want to find out how he makes his money and whether he is the acceptable face of the filthy rich.
What is the stock exchange and how does it work? The stock exchange is nothing more than a giant, globally networked and organized marketplace where every day huge sums of money are moved back and forth. In total, over 60 trillion euros a year are traded. more than the value of all goods and services of the entire world economy. However, it's not apples or second-hand toothbrushes that are traded on this marketplace, but predominantly securities. Securities are rights to assets mostly in the form of shares. A share stands for a share in a company. But why are shares traded at all? Well, first and foremost, the value of a share relates to the company behind it. If you think of the value of the company in terms of a pizza, the bigger the overall size of the pizza, the bigger every piece is. If, for example, Facebook is able to greatly increase its profits with a new business model, the size of the company's pizza will also increase, and as a result, so will the value of its shares. This is of course great for the shareholders. A share which perhaps used to be worth 38 euros could now be worth a whole 50 euros. When it's sold, this represents a profit of 12 euros per share. But what does Facebook gain from this? The company can raise funds by selling the shares and invest or expand its business. Facebook, for example, has earned $16 billion from its listing on the stock exchange. The trading of shares, though, is frequently a game of chance. No one can say which company will perform well and which will not. If a company has a good reputation, investors will back it. A company with a poor reputation or poor performance will have difficulty selling its shares. Unlike a normal market in which goods can be touched and taken home, on the stock exchange only virtual goods are available. They appear in the form of share prices and tables on monitors. Such share prices can rise or fall within seconds. Shareholders therefore have to act quickly in order not to miss an opportunity. Even a simple rumor can result in the demand for a share falling fast, regardless